Hi there. In this video, we'll explain a common residence nil rate band trap and why proper estate planning matters in 2026.
Picture this. You're a highly successful UK contractor working through your own personal limited company. You're in your 60s, you've built up a fantastic business, and you own a beautiful family home worth, say, £800,000. Now, like any loving grandparent, you want to protect your wealth for the next generation. So you draft a will leaving your home to your grandchildren, but you add a very standard condition: they receive it when they turn 21. Sounds incredibly sensible, right? Well, that single well-intentioned age condition just accidentally triggered a massive 40% inheritance tax bill on a chunk of your estate that could have been completely tax-free. Hello and welcome to this explainer brought to you by Pro Tax Accountant, the UK accounting firm advising businesses on tax planning and compliance. Today we are unpacking a massive, hidden pitfall in UK inheritance tax rules.
It really begs the question, is your will actually a tax trap? As a contractor or SME director, you spend your entire working life optimizing your corporation tax, your dividends, your VAT, the whole shebang. But so many successful business owners completely overlook how standard will drafting can accidentally forfeit crucial tax reliefs. By simply throwing in a standard age contingency for your grandkids, you might be unintentionally disinheriting them from a massive tax relief, effectively handing a huge portion of your life's work straight over to HMRC.
And just to put a hard financial figure on this oversight, let's look at the actual damage. £140,000. That is the potential cash loss to HMRC for a married couple who unknowingly lose the Residence Nil Rate Band, or RNRB for short. Think about that for a second. If both spouses lose their $175,000 allowance, that's $350,000 of the estate suddenly exposed to 40% inheritance tax. That is $140,000 in actual cold hard cash completely wiped out from your family's inheritance, literally all because of a few poorly chosen words in a legal document. Okay, let's dive into this. Here is our roadmap for today. First, the costly estate planning trap. Second, how the RNRB actually works. Third, the grandchild age contingency trap. Fourth, the $2 million taper threat. Fifth, fixing the trap post-death. And finally, protecting your wealth today. Section 1. The costly estate planning trap. The core conflict we're dealing with here is the huge disconnect between what seems like common-sense family planning and the incredibly rigid, unforgiving nature of UK tax legislation. Relying on standard, older will drafting, especially things like discretionary trusts or age-delayed inheritances, can entirely bypass the modern criteria required to secure your property tax reliefs. Did you know that the inheritance tax thresholds have been effectively paralyzed by the government? Many established companies and contractors encounter this issue when reviewing their tax position, completely unaware that the RNRB is literally frozen until 2031. This is a classic textbook case of fiscal drag. Because property prices and business valuations generally rise with inflation, but the tax-free allowances remain frozen, more and more SME owners are silently being dragged into this exact tax trap every single year.
Section 2. How the RNRB actually works.
To understand how you lose it, we first need to quickly understand how you claim it. Notice how these tax allowances stack up. Every individual gets a standard nil rate band, or NRB, of £325,000. Now, that allowance has actually been frozen since way back in 2009. On top of that, if you qualify, you get the Residence Nil Rate Band of £175,000. That gives a single person a potential tax-free allowance of $500,000. And because spouses can transfer their unused allowances to each other, a married couple can combine these to shield up to $1 million from inheritance tax. But, and this is a massive but, that $175,000 top-up comes with very strict strings attached.
The absolutely crucial point is meeting HMRC's strict definitions. First up, you need a qualifying residential interest, or QRI. This simply means the property must have been lived in by you as a residence at some point. A pure buy-to-let investment property that you've never actually lived in, yeah, that doesn't count. Second, the property must be closely inherited by a direct descendant. HMRC is very specific here. This strictly means children, grandchildren, great-grandchildren, or stepchildren. It emphatically does not include nieces, nephews, siblings, or unmarried partners. So if you leave your home to your nephew, you lose the allowance completely. No exceptions.
Section 3. The grandchild age contingency trap.
Now we are at the absolute heart of the issue, and it's where even the most diligent business owners trip up. Why? Because the law contains a truly bizarre statutory double standard, and this brilliantly illustrates that double standard. If you leave your property to your own child, contingent on them reaching age 21, the law treats this favorably as a bereaved young person's trust under Section 71D. It qualifies for the RNRB perfectly fine. But if you make the exact same gift with the exact same wording to a grandchild at age 21, it fails. Why on earth does that happen? Well, because the grandchild does not inherit a vested absolute beneficial interest immediately upon your death. Instead, the property enters what HMRC calls a relevant property trust. Because the property sits in this trust waiting for the grandchild to turn 21, HMRC says it hasn't been closely inherited. And just like that, poof, the $175,000 allowance is gone.
Section 4. The $2 million taper threat. As a successful UK contractor operating a limited company, your wealth isn't just tied up in your house, right? It's in your business bank accounts, your investments, your pensions, and this brings an aggressive secondary threat to your overall wealth. £2 million. This is the net estate taper threshold. HMRC calculates the total value of everything you own at death, minus your liabilities, like mortgages. But crucially, this calculation happens before any business or agricultural reliefs are applied. If that net number crosses the £2 million mark, your RNRB is in grave danger.
Let's look at the brutal math of the taper. The RNRB withdraws at £1 for every £2 your net estate exceeds that $2 million threshold. So let's walk through a quick example. If your estate is worth $2.1 million, you are $100,000 over the limit. Your allowance is then reduced by half of that overage, which is $50,000. If your single estate reaches $2.35 million, the entire $175,000 allowance is completely wiped out. For a married couple, this taper can rapidly erode that combined $1 million shield we looked at earlier. It demands incredibly careful calculation. Before we move on to the solutions, here is a professional tip for you. Maintaining proper records is absolutely essential for HMRC compliance, especially if you plan to claim a downsizing addition. The government knows that people sell large family homes to move into smaller places or care facilities as they get older. If you downsized or sold your home after the 8th of July 2015, you can still claim the RNRB using a downsizing addition, provided you leave assets of an equivalent value to your direct descendants. But, and it's a big but, to claim this, your executors must have flawless documentation of that property sale. Do not throw away your old conveyancing files.
Section 5. Fixing the trap post-death.
So, what happens if someone has already passed away and their will contains this fatal grandchild age contingency? Well, all is not necessarily lost, but the executors must navigate a very narrow, very tricky legal obstacle course. Let's move to the timeline and see how this builds. There is a strict post-death window for emergency action. If a property is stuck in a contingent trust for grandchildren, trustees can use Section 144 of the Inheritance Tax Act to appoint the property directly to the grandchildren, effectively reading it back into the will to save the tax. But look at this timeline. You cannot do this immediately. If you distribute the property within the first 3 months of death, you fall straight into the Franklin trap, a legal precedent that voids the tax rescue completely. You have to wait for 3 months to pass, but you absolutely must complete the legal action before the 2-year anniversary of the death. It is a highly specific, high-pressure window.
So, the exact steps your personal representatives must take are: number 1, immediately identify the age contingency flaw in the will. Number 2, patiently wait out the 3-month Franklin trap period. Number 3, execute a deed of variation or appointment. This sometimes involves using specific rules, like Section 31 of the Trustee Act, to legally convert those contingent interests into an outright immediate interest for those over 18, so the tax relief isn't lost. And number 4, secure the RNRB claim firmly before the 2nd anniversary of the death. As you can tell, it is highly technical and absolutely requires specialist legal and tax intervention to get right.
Section 6. Protecting your wealth today.
Scrambling to fix a broken will post-death is stressful, it's expensive, and honestly, sometimes it's impossible if minor grandchildren are involved and court approval is needed. Proactive lifetime planning is infinitely superior. As a UK contractor or SME director, here's what you need to do right now. First, avoid placing the family home into a discretionary trust in your will. It almost always kills the RNRB dead. Second, remove arbitrary age contingencies for grandchildren if you must leave property to them. Ensure the drafting allows for absolute vesting or uses an immediate post-death interest structure. Third, constantly monitor the $2 million taper threshold as your business cash reserves grow. And finally, review your will today to ensure the wording actually aligns with the 2017 RNRB legislation, not the outdated laws of 2005.
Estate planning mixed with business ownership is a minefield, for sure. But you don't have to navigate it alone. Contact Pro Tax Accountant today to ensure your company structure and personal estate plans are perfectly aligned. You can reach the team at 07985689912. Drop an email to info@protaxaccountant.co.uk or visit www.protaxaccountant.co.uk. And hey, if you found this explainer valuable, please make sure to subscribe to the PTA YouTube channel for more deep dives into the tax strategies that protect your hard-earned wealth.
Please note the disclaimer here. This explainer is for informational purposes only and does not constitute formal tax or legal advice. Always consult a professional for your specific circumstances. I'll leave you with this final thought. You've spent decades building your business, paying your taxes, and growing your wealth for your family's future. But if your will contains a hidden age contingency, is your life's work truly protected from HMRC? Take the time to check your documents today. Thanks for joining me, and we'll see you in the next explainer.